Hello, and a very good afternoon to everybody. So, as we present the very first edition of this year, we are sure to stay committed in bringing to you the numbers which speak louder than words and sometimes even which speak louder than narratives and sometimes even challenge them. With that thought, we wanted to make it a little special this time. So we have packed it with some of the most eye-opening lessons from our past year's editions. This time, we are focusing on bursting some widely held market myths. One of the most talked about being economic growth translating into stock market gains and diving into how the long standing calm in the markets that we have extensively talked about through our previous editions has finally begun to unsettle, and what that could mean for all of us. So, now finally, before Sahil takes over, just as a note, throughout the course of the presentation, you guys can post your questions in the question answer tab on your screens below, and we'll collectively take them towards the end of the presentation. Thank you.
Good evening, everybody. This is the January edition of DSP Netra, and we'll straight away jump into the most important insights that we're going to gather. And as you know that we write this 5th of every month, and there is an online link where you can go and look at all the past publications. So this time we thought that let us look at some of the most important narratives. Why most important? Because they are the ones which are usually used the most, and a lot of people believe that they are true, and they also appear true. It is very difficult to refute them because on the face they look true and they appear true. But we thought that let's use some data and try to see whether they hold the test of time and whether they hold the test of data scrutiny. So we'll talk about 7 myths and and how to look at them, how to think about them. The first is the most used, and I think in all the narratives, there have been books written about it. There are global views and whatnot, and the myth is that markets always go up, or maybe put in a different manner, that if you stay for a very long period of time, you will get returns. Now, this sounds very logical, and it also may be actually logical because this actually comes from the literature and experience of the American investor. And for American investors, this has been true since 1871 or maybe longer. Data is available from 1871. The American market or US market has delivered nominal returns in excess of about 10.5% and real returns of about 7% plus over this about 150 plus year period. So it does appear to be true that markets always go up, or you could say they eventually go up, and it has been true in case of United States. But unfortunately, it is not true in most other markets. And there are two very big qualifiers when we talk about markets always go up. So first, we'll look at the data that we've presented on the screen. What we've done is that we've taken a 30-year period, which is long for a lot of markets because in many markets the data is not, it doesn't go beyond 30 years, or in some markets it is even shorter. So we looked at actually a lot more markets, but here is the data for a few of them. More than a dozen markets are presented here. You look at the 30-year CAGR return for a number of markets. The first column is the local currency return, which means the return that we speak on a daily basis, where when people are talking about Indian markets, we talk about Nifty went up 1% or fell 1%, or in the year it went up 8%. This is that return, the local currency nominal return that we keep on chatting on a day-to-day basis. This is the CAGR of how was the annual return for that market in that year. So you can see that for many countries, the CAGR for the last 30 years is low single digits. Okay. And when you adjust it for inflation, because inflation eats away the buying purchasing power of your returns, of your value of your currency, you can see for many markets, the returns have become negative. Specifically for markets like Malaysia, Philippines, Korea, Japan, you can see the returns are negative. There are few markets, for example, India and United States, where returns are reasonably strong. In fact, United States has a 6% CAGR, which is a strong number. And when you compare all markets in the same currency, which is the United States dollar, so that all currencies are all returns are similar and they can be compared, you will see that very few markets, after adjusting for inflation, can beat United States bond market, right? 2% real return, few markets have delivered, which means that for most markets, you were better off buying bonds because bonds are less volatile than equity, or put in another manner, in most markets, you were not better off than the bond investor. Although you had the volatility of the equity market, investor was worse off than holding bonds. Only in a few markets have bonds been beaten by equity, specifically India and US being the key markets where they've outperformed by a large margin. You see China being, two times China mainland and China HK listed. There are two different Chinese constructs here. China HK listed has the longest history because that was the exchange where a lot of companies were listed henceforth. And in China mainland, the data is spurious, shallow. In fact, the first stock exchange in China started operating only in 1991. So by the time this data would have started to flow, few companies were listed. So this may be slight misrepresentation, and therefore Chinese returns also are very, very low. So in fact, there are only two markets which stand the test of time. Uh, and let me here introduce to you a term called falsifiability. What is falsifiability? It tells you that even if you can gather one data point which can falsify a theory, that means that theory is wrong. So, for example, if the theory says that all equity markets or any equity markets gives returns over the long term, and if you can find even one market which doesn't follow this rule, that means this is not a rule. And this is a case where we have many markets which do not deliver longer term returns. Therefore, there is no entitlement, there is no number, there is no proof that over the long term equities perform. And what could be the reason? So there are many reasons. First reason is that we may not be born in a lucky period. So, for example, think about people who were born, let's say, in 1925 in United States. For 30 years, markets gave no returns, right? So their experience would have been very different from people who were born, let's say, in India of 1990, and in the next 30 years, markets delivered very high returns. So one is, of course, how lucky we are to be born in certain market conditions. Second is, of course, skill. There are a lot of investors globally who can, whatever the market does, they can produce returns by picking stocks. So whether we have that skill or not, again, is a very important issue. Many people do not have, as we all of us know that it is a very difficult skill to acquire. Third and very, very important fact is that there are accidents. There are events which are out of our control, like wars, like COVID, like other events which happen from time to time, like political instability, inflation, etc. These things cause economic, political, all other turmoil, which can sour all the returns that our equities delivering. And therefore, these are unknown, unpredictable events, and you cannot rely on ability or anybody's ability to forecast these events. And therefore, this myth that markets always go up has to be corrected. Also, in the last 25 to 30 years, Indian markets have enjoyed very, very strong returns. Of course, in the last 5 years, those returns look exceedingly strong. Maybe there was a time in between when returns were not looking so handsome, for example, during the COVID decline. But overall, we've done quite well. 25 to 30-year period, Indian markets have done well. And because of this period of 25 to 30 years, let me also introduce to you another important point, which is called problem of induction. When we look at the past data, and if the data tells you something, for example, Indian data tells you that in 25 to 30 years, Indian markets have delivered, let's say, 10% or 12% return. We start believing that in the next 25 to 30 years, this return will automatically come. This is not true. So, looking at a specific set of data, the extrapolation of that same data is a big mistake. And therefore, two lessons from this slide. One, there is absolutely no entitlement of what could be the future return looking at just the past, which also means that this table itself may not be very useful, which means that this is not a representation of what will happen in the future. There is a possibility that in the next 30 years, this table is reversed, which means more countries deliver higher returns than what we are showing right now. That is also possible. But one thing is clear that markets do not always go up. They are cyclical. They go through phases. And in fact, stock returns are dependent a lot more on what the businesses are doing or the managers of those businesses are doing, which we will talk about in one of the myths when we come down to it. So takeaway, do not believe that over the longer term, eventually the markets have to rise. There can be many periods when they do not rise, and therefore you have to set your expectations correctly. And also, quality of your investment becomes very, very important. Let's go to the second myth. Second myth says that if GDP rises, so will the stock market. And this is a sort of my favorite one because in India it is used on a daily basis. We say that if GDP grows from 3.5 trillion to 10 trillion, market cap will also go up. You see and read in newspapers where people make predictions that Sensex will go to 1 lakh, 2 lakh, 3 lakh, 5 lakh, basis of these numbers, that if economy goes to that size, Sensex should also go to that number. And this is one of the biggest fallacy. When you look at global example, there are very few countries where this has happened. In fact, we are the basket cases where economic growth and stock market growth has coincided. In many countries, it has not. So, for example, look at the last 30 year again data for many of the countries that I showed you on the last slide. Look at China for the time being. China real GDP growth rate of 8.6%, local currency return of 5.6%, real returns of 2.3%. Although the better and more liquid market, which is the HK listed market, returns are negative. Chinese markets delivered negative returns. Even when you look at MSCI China, which is a broader index, 30-year returns are negative. So the fastest growing economy in the world has delivered negative returns. Look at Brazil, 2.4% growth rate only, local currency returns of 11.7, and inflation adjusted return of 5.1%. Very high returns, although the economic growth is not so high, right? Which means that there are many permutations and combinations available globally for you to see, which will falsify any belief that there is a linear relationship between economic growth and stock market returns. It is not. And in fact, there are many instances where in countries which were growing at a very steady pace, some sort of disasters happened and equity markets delivered very high negative returns. One very recent case in point is Russia, right? And there are many such examples that you can build. Argentina, again, is one of the examples where you will see these numbers when you adjust them for inflation, they absolutely go out of control, right? And many countries which were growing at a very steady and strong pace did not deliver any significant returns. For example, uh, look at Korea, right? A developed country, one of the Asian miracles, right? South Korea, one of the most developed countries in the world, and the only developed country to be developed in Asia after the World War II, of course, ex-Japan. And you can see that Korean returns for the last 30 years are negative, which is unbelievable. A country which probably grew at one of the fastest pace in human history and created a magnificent framework for its citizen delivers negative returns. So this idea, this thought itself that GDP growth is the reason why you should look at equity market is a very flawed concept, and you should think twice about any narratives which are built on top of it, and many narratives are built on top of it. For example, narratives like GDP growing from X to Y, and therefore a defense sector or a manufacturing sector going from X to Y, and therefore companies growing in that sector. These all may be enabling environment issues, but they do not cause returns. They are not responsible for delivering equity returns because equity returns are not a function of GDP or economic growth alone, right? They may be enabler, and we look at how are these enabler important, and we'll also look at why do equity markets perform. So, which is our myth number three, which I just covered, that India outperforms because of GDP growth. So we you know wanted to answer what is the then. So, for example, the next question could be then what is the reason why has India performed so well over the last few years. And maybe US has also performed so well over the last many decades, not just few years. So one of the reasons that you see on this slide tells you something about return on equity. So what is return on equity? What is the amount of return the shareholders are earning on the equity that is provided in the business? And that metric is a very important metric. It tells you uh, a fact that are shareholders earning a respectable or a decent return on their investments. So when you look at this data on your screen, there are a few countries put here, and in the lower panel, we've put emerging markets together. So I'll explain what do I mean. But these are the top countries where the results were the best, and that's why we've taken them. Other countries, the results were worse than these numbers, and therefore we did not even include them, right? So, for example, how to read these numbers? In the last 10 year, the average ROE in United States is 15%. And there are 39% of the companies in US, which is from the S&P 500, have a ROE of more than 20%, right? So roughly, if you take about the S&P 500 has about 500 companies, so roughly about 195 or so companies have a ROE of more than 20% over the last 10 years. This is the highest number provided. When it comes to India, one third of all companies, again, you take Nifty or NSE 500, the data is very similar, have ROE of more than 20%. On an average, ROE has been 14%. So there are more number of companies in India and US which give higher shareholder returns. And this, I think, is one of the reasons why India has outperformed and the basis of outperformance. And this data will be different for different countries. For example, let's say in China, where interest rates are now less than 1%, less than 2%, earning a high ROE is very difficult. So in China, even a 10% ROE is fabulous. So you might ask me that 20 is not equal to 20 in India. So therefore, the lower panel, where we have adjusted the return on equity for cost of capital. Even when you adjust it, because India's cost of capital is much higher, still our ROEs are superior than rest of the world. In fact, in emerging markets, they have destroyed wealth. India has earned a very high return on equity for investors, and this is the precise reason. So when you think about investing in India and you think about the long term, this is what you should think about, that can my portfolio companies earn a decent return on equity over the next 20 to 30 years? If the answer is yes, then you should be thinking about long term. Then the answer to the second myth, where will GDP translate to equity returns, also becomes yes, because a lot of high ROE companies will be able to deliver high shareholder returns, right? We will not go into this question on why India has high ROE. Maybe on a later date, we'll give you a breakup of what makes high ROE sustainable in India. But the answer is not very beautiful. It's slightly ugly. But we'll come to that in a later edition of DSP Netra. Uh, Also, an enabling factor in India, very similar. When I spoke about return on equity, you can see that we put together some global leaders and we've compared them to Indian leaders. So, for example, when we go to a sector like aerospace, you can see that we've taken a global leader company, RTX Corp. In pharma, we've taken Johnson and Johnson and then compared them to Indian leaders, BEL or a Sun Pharmaceutical in banks, HDFC. You will see that over the last 20 years, Indian leaders have had a average ROE, which is higher than the global leader. Okay. And they also have a EPS growth rate, which is bigger or stronger than the global leader. Only in case of automobiles, where the Indian EPS is similar, and in case of construction, where our EPS growth rate is slightly lower, in most buckets, India leads, where our ROEs are superior and even our earnings are superior. And these numbers are local currency numbers adjusted for inflation, right? And therefore, it tells you that Indian businesses have delivered by a very strong margin. And what is the reason for this delivery? It squarely resides with all the managers, entrepreneurs operating in India. So if you were to pick one crucial factor why India outperforms over the longer term, it is the ability of Indian managements, Indian managers, businessmen to deliver high ROE in all environments, in all conditions. And I think that is the right answer or the myth buster, that India has worked over the longer term, and the reason resides in businesses' ability to create shareholder returns, and not only about enabling factors like a GDP growth, etc. They are important, but they are background enablers. There are many countries where there was very poor GDP growth, but businesses were able to deliver, and they delivered significantly superior returns for all shareholders. Another two slides I will share on the enabling factors now. So a lot of people talk about these factors alone, but I think they are only enablers. So for example, in terms of India's investments or what is called gross fixed capital formation, India used to be at number 10 in 1990. We were spending about $84 billion annually in building ports, railways, houses, all these infrastructure fixed assets, right? Over the last 30 years or 34 years, our position has now turned to number three. Our growth rate has been at 4.9%, which is a very, very strong number for India. I'm sorry, at 8%, which is a very strong number. Only China has grown at a faster rate of 14%, right? So India has enjoyed a very strong growth rate. Its gross fixed capital formation has gone up, gone to number three, and the position looks very strong. Now, what does it mean? If you look at the table very clearly, uh, it tells you that there are only three countries which do, or four countries which do more than $1 trillion in investments. So this enabling feature tells you that you cannot now ignore India in terms of investments or fixed capital formation. So this, I think, is a very, very important factor that we should always remember. Second, uh, and more importantly, you will see that Indian consumption has also actually been very, very strong, right? Indian consumption, which was uh, it is one of the backbones of India's economy. You can see that about in 1990 we were at number seven slot, spending about $215 billion in terms of consumption. Um, Now that number has gone to 2.2 trillion. So there are only about four or five countries or six countries, five countries excluding United States, which has about 2 trillion plus dollar in annual consumption. And India has now joined that club. So, in that sense, global businesses, domestic businesses now has a much bigger market, what we call TAM, total addressable market. It has become very, very large, and our growth rate is also superior, right? So this again tells you that we have a very strong enabling environment, but an enabling environment does not matter unless businesses deliver shareholder value, right? So that has been missing um, from the source, right? So next myth is about gold, and I think this is something which is uh, uh, you know uh, we put out on social media platforms also, and we used it in last year's Netra as well. And this is a very, very important table. When you look at the various countries, various emerging markets, what we've done is taken data since 1999, sort of 21st century data. You look at local equity market returns and total gold returns, you will see that in most countries, except in India, gold has beaten domestic equity markets, which means that if you were to buy the domestic equity index in Turkey or Brazil or Poland, or you were to buy gold, gold will outperform in local currency terms in sitting in that country, right? So this is a fabulous outcome. Even if you look at data from United States for the same time, gold beats even S&P 500. If you look at the same data, let's say in Eurozone, in 9 out of 10 countries, it beats. In fact, I think there are only two markets which we could pinpoint. One is India, where gold has slightly underperformed, and another is Australia, where the underperformance is only 20 basis points. For most other countries, and I think almost all other countries, gold has outperformed. What does this mean? That the lot of there are a lot of factors, lot of local accidents which happen, like political turmoil, wars, etc., which cause large currency depreciation, and that causes currencies to weaken and domestic gold returns to go up significantly. And this, I think, has played out brilliantly in emerging markets. This also tells you why you should have some amount of protection, or some amount of gold exposure built into your portfolio. It is sort of a disaster hedge. And this, I think, is a very important data point. It also tells us about myth number five. Myth number five is that a lot of people believe that equity is everything. If you have equity, then you will have long-term wealth. That may not be true. For when you look at the data on diversification, and if you diversify across four assets, what are those four assets? Equities, debt, international equity, which means buying equities which are outside of your country, gold, and if you mix them in equal proportion, you will get a multi-asset allocation portfolio. So when you look at this data, in most markets except in US and India, which is a more recent phenomena, multi-asset allocation beats domestic Indian equity. Right? In India, the difference is only 50 basis points. In US, the difference is slightly higher, largely because in US the debt returns are very, very low and international equity has not delivered, so US equity has delivered. So because of that, returns are slightly lower, but still they are very respectable. What is more notable is that the standard deviation or the volatility of a multi-asset allocation portfolio is much lower, which means that think about this: if markets fall, the probability that a mixed asset portfolio or a multi-asset allocation portfolio will fall less is much higher, right? And therefore, it will help you stay invested for a very long period of time. And as we have shown earlier also, in investing, the most important principle is not return, but it is time. If you're able to compound your money even at 7% over a 100-year period, um, 1 rupee can become 40. And therefore, this strong compounding happens because of time, not because only because of return, right? If you go for high return and higher volatility, chances are that if the negative deviation comes, which means that the crash comes, your ability to hold on will get challenged, and therefore you will get knocked out of your investment. And therefore, multi-asset allocation is a brilliant concept, and we believe that this is one of the concepts where you don't have to ask the question whether should I invest today or not, whether do I do SIP or lump sum, etc. So we think that this is a brilliant category and it is here to stay for the long term. A lot of new investors and maybe a lot of old investors also should choose this category over any other category for that matter. The next is on SIP or systematic investment plan. And largely we see that when people see their portfolio sizes become much larger and they become more sophisticated in nature, they start to believe that they can time the market perfectly, right? And and therefore they believe that SIP may not be their most preferred choice. But we've seen that in almost all markets in the world, whether the performance was there or not, whether equity markets delivered or not, had you done a SIP, your returns were much superior than lump sum returns in most countries, right? Um, and this is true when you adjust it for inflation, it becomes even more important because in countries like Japan or where the returns were very low, you end up making a much better return when you do a SIP transaction or your real returns improve significantly. And therefore, there is a cross-country visibility analysis, cross-country validation of data that tells you that systematic investment plan, which means that systematically putting equal amount of money every month beats all other forms of investing. And what is the reason for that happening? Because an investor, you accept average returns, average valuations, and therefore the whatever the market delivers, that is what you get. So, and it also helps you accumulate a lot more investment when markets are lower, when they are falling, and therefore your value of your units go up significantly. And therefore, we believe that SIP is a strong, positive, way of investing, and almost everybody should exercise SIP in one manner or the other. One question to all of you, where I will not give an answer, maybe an answer at a later date, but a thought experiment that if SIP is such a superior investing strategy, why do we not see SIP book announcements like we see for India every month? I think we saw one today. Why don't we see those announcements coming out of China, Japan, Germany? Where are those investors? Why they are not doing SIP and announcing these books that our SIP book has become so and so $1 billion? Many of these markets have been there much longer than our markets were there, right? So therefore, you need to ask this question: why are other SIP investors missing? Where are they, right? We'll maybe give an answer on a later date, but it's a very, very important question that you should ask yourself. Myth number seven is quality businesses have highly stable prices. So a lot of people believe that if you buy the right kind of stocks or great stocks, great businesses, then you are sorted and there is no pain period. But the reality is that stock markets are volatile, inherently volatile. That is the nature of how the markets are. It is not a bug, it is a design, right? Why it is a design? Because market prices are dominated by human emotions, and emotions change for many narratives and many reasons, and therefore people end up making mistakes and stock prices become very volatile. So here we've taken 10 of the largest Indian and American companies and look at the data, and you can see in the last 30 years, almost all of them had declines of more than 50%, whether it was India or United States. You can see many of them happened in the 2008-9 crisis, many in some different era, many even in COVID era. But you will see that these declines will occur from time to time. And why are we showing this? We are showing this to you to tell you that even if you have bought right, there is still a chance that you will see a very large decline. And therefore, as investors, you should be prepared for highly volatile outcomes. If you are 100% in equity and you cannot digest a 50% decline, then you should not be in pure equity asset class. You should be diversified. You should have bonds. You should have multi assets. But if you can take those declines and continue to stay invested for a very long period of time in the right companies, then there is a good chance that they will be able to outstrip bond returns and deliver higher returns. And therefore, never believe that any stock for that matter, whatever the company is, whatever the business is, any company can see its stock price decline 50%. Whether the business performance has gone bad or not does not matter because stock prices are dominated by emotions. The second portion, we've listed about seven myths. The second question is a revisit of one of our hypotheses called the unsettling calm, where we've updated some data that we thought is very, very critical. First is the data on 8 years of calm has now turned to 9 years of calm. Now we are in a period for where 9 years Nifty has not declined at all, which means year on year return is positive. Second is that except the COVID decline, which we do not mark as a bear market because the markets did not remain low for a 12-month period. The markets have not fallen more than 20% for a longest duration. It's been more than 9 years now. And in fact, in the last 13 years, Nifty has not declined by 10% or more, even for one single year. So these are very rare events. I have highlighted in the past also that there is only one another market, which is US market, which saw a 22-year rally without any decline of more than 5%. And there is no other precedent. So we are the number two. And in history of all stock markets across the world. So these are not common reoccurring numbers. They are very rare. They are sort of a Six Sigma event, but they are so long term in nature that they don't appear to be that way. So you should know that we are already in exceptional uncharted territories. Second is how this unsettling calm is going on a daily basis. So we had consecutive positive days close, 14 positive days close, I think 2, 3 months back. I think it was in August or September, where markets rallied for 14 straight days. Hasn't happened, and then it got broken. Now we are in 56 months of five less than 5% decline for the market, but continued rally. It got broken in December, where markets fell more than 5%. And then I think in November. And then you have we also broke our six quarter streak of gains. Streak broken at 6 quarters again. And then you have this continues with 13 years without 10%. So some streaks are still continuing, which I spoke to you about earlier, and two of them have been broken. So I think there are first cracks which are beginning to appear. What do I mean by cracks? This unsettling calm, which we've highlighted earlier, I think it is beginning to break, which means that volatility is starting to rise, or markets are shifting gears. They're shifting from slow upward trending move to more volatility and maybe more violence. and therefore you should be more careful and more conservative in your approach. And please remember that volatility comes in bunches. There are large periods when there is very low volatility, and then a sudden jump in volatility, and then a regime where volatility remains high. So these are bunches, they come together, and maybe we already have first signs that some of that volatility bunch is beginning to appear. Next is the margin of safety. We've highlighted that on the broader market parameters, most stocks appear pricey. And this overall picture tells you that specifically in small and mid cap universe, you see the green bands, less than 19% stocks, are trading at less than 20 times price to earnings multiple in small and mid cap space. And you can see that more than 55% of small and mid cap stocks trade at 40 times or more price to earnings multiple. In fact, 32%, one third of the universe has more than 60 time price to earnings multiple. A very, very high number, right? For large cap, these numbers are slightly lower. They are, you can find some value in some large caps. For mid and small cap, there are very few stocks where you have to really hunt for them. In fact, only one fourth or 25%, 26% to be precise, small and mid cap stocks have a price to book multiple which is less than 3, right? A very rare occurrence, very rare occurrence. And this tells you that broadly, there are a lot more stocks which are expensive and very few companies which are cheap. And this again is, we've highlighted this earlier, that if you pay 40 times plus for stocks where earnings are growing at 10, 15% and ROEs are 14, 15%, it's not a good outcome. You really have to tone down your expectation or increase your investment horizon to beyond 10 to 15 years. Otherwise, the returns will be very hard to come, right? And this is the current state of affairs in terms of valuations. Next, of course, is the last slide where a lot of promoters have started to offload their stake, and the numbers have been just mind-boggling. The amount of selling which has happened from promoters, 1.2 lakh to 1.5 lakh crores YTD in FY25. We've rarely seen these numbers. In fact, there were 132 IPOs in calendar year 2024, highest in the world for any country. Our volumes were 30% of US volumes, where the market cap is 20 times higher than India. So the numbers are completely out of whack. We haven't seen this kind of selling from promoters, and likely reason is that the valuations are too attractive to not sell. And I think that is probably showing up in numbers where promoter selling is very high, although retail buying, client buying, or maybe institutional buying is also very strong. But at the same time, promoters are offloading their stake. So these are signs which tells us that this is a sign, this is the time to be more conservative rather than being more aggressive or adventurous. And the bunch of volatility that I spoke about is beginning to increase. And we've spoken about earnings slowdown earlier, margins compression earlier. All those factors are also at the background, which will probably cause some amount of corrections or time correction for equity markets in the times ahead. So this was the brief description. One last important relative play that we've highlighted for the last 5 to 6 months is the favorable position of the large caps. And now that position has started to flip, where largest cap companies or the top 10 companies or even the Nifty 50 has started to slightly outperform on a relative basis to the broader market. Although the outperformance is very, very marginal today, not very high. And in fact, small and mid caps are yet to show any meaningful decline. But the rate of change has started to favor large caps. And this we think is the first instance which tells you that even from a price perspective, we were talking about valuations and where the value lies. But even from the price perspective, things are beginning to turn where a large cap or market is, changing its focus more towards defense and safety rather than towards aggression and offense. Um, so with this, I will stop here and end here with this, behavioral slide and maybe call Pragati back. But this slide tells you that just because the recent past was very rosy, it does not mean that the future will also be rosy. It can have many outcomes. So we need to be prepared. We need to exercise and create portfolios which can thrive in almost all environments.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.